people are in so far. Are you ready? Oprah says, are you ready? Regarding internal control, which of the following statements is true? COSO is a best practice. This will come up in the next afternoon session. How did it go? Score-wise.
Oh, whoops.
This little thing.
Clicked it too many times. Sorry.
When is a grant under pre-uniform guidance rules?
What?
I probably will appreciate this when I'm older. If the grant was awarded prior to 2014, the ladies gave me that question to add into here. How did it go? Go Spurs, go! ASU stay in Vegas. Where are overhead rent break charges accounted for in a multifamily project? The non-front line go where? I'll get out of your way. Hey, Liz, you're not a very big window. Yeah, but speed's the purpose, right? Management fees, remember, all non-front line expenses in the HUD project are covered in the fee. So, KPMKE. Never sure what to think when they have all this. I can't make a word out of that, so it's KPMMK. KPMKE. Made it. Which of the following is required under uniform guidance? Hey, Sean, will you hit Control Plus on your keyboard? That thing's in there. Okay, for those of you who selected green, remember that's A133 at $10,000. 25 is uniform guidance. The top two aren't uniform guidance things, they're just included in a filing, but they're REACT requirements. The mortgage balance at year end is in the footnotes under uniform guidance. KPMKE. Sven. Do you have a reindeer too? Go Spurs, go. This is a pretty tight grouping at the top. Okay. What town in the UK is comparable to Las Vegas in the fact that you could get an easy marriage? Oh, what the? Why we have to go international on this, I have no idea. Shouldn't ask, is anyone planning to get married here this week in Vegas? Or divorced, married and divorced? Gretna Green, Scotland. Boy, that's news for you. That's a street breaker. Didn't change much at the leaderboard. Next question. Under UG, there is no de minimis balance. The new equivalent is below the limit, you don't risk assess. What is that limit? Gosh, what is it? 25% of 750. False. 187.5. Okay. Some people can do the math. Next, let's see how'd it go. KPMKE. Boy, Apparently know the single audit. The help has come up. Little tightening. Barney Fife's coming though. What do UG program procurement requirements apply to? Goods and services charged to federal awards. Awesome. Man, KPMKE. No single audit. Okay, I'm going to find out if you win the award. I'm going to see when you want to speak at the conference next. Okay, next. Which of the following are required note disclosures for the CFA? Do you know?
I like the fire.
We like that distribution. All of the above. KPMKE. Oh, Groot. I am Groot. I am Groot. Okay, well, how much does the cheapest option cost to get married in Las Vegas? If you got a daughter, you're going to send her here. Now, this is something I really needed to know. $75. Boy, I'll tell you. Never mind. I had something else that was going to come out of that mouth of mine, but I thought, never mind. Okay, KPMKE, you're still up there. Halvor, though. Halvor came up on the board. Now, we've got an opening. Which of the following is not a criteria for low-risk auditee for the previous 2 years? Low-risk auditee. It's on the bottom row. Did you answer all right? Did you? Bottom right? My left. No significant deficiencies. It's only material weaknesses now. The other 3 are staying, but no material weaknesses. KPMKE. Picked up some points. Halvor's coming. Groot's there. Kind of close still. Got to stay in the money. Here we go. Next question. Which of the following is not a criteria for a low-risk program? Known question cost greater than $10,000 is the incorrect answer. I got a 25 for the first person to shout the correct answer. Not 25,000. What would it take to make red the right answer? Known question cost greater than 5%. Program awards. I can't toss that stuff at all. I've given that card away exactly 3 times this entire year. Congratulations. Now everybody goes after I say it, they go, oh, it's on the form, and I said, that's the problem, right? It's on the form, but nobody's paying attention to what's greater than 5%. KPMKE, Halvor is knocking at the rear door. Here we go. Which of the following affects the auditor's opinion on compliance? Paragraph 516. Okay, folks, this is a scary thing for me personally because paragraph 516 says something very specific in uniform guidance. It says, a finding is mandatory if the question cost you find is greater than $25,000. And then they're going to tell you the things you find are the known things. Known things become findings. Then you take the known, if it's a projectable thing in a sample, and you calculate the likely question costs. The likely question costs are not booked as findings, they affect the opinion. And that's a very specific thing. It's actually a theoretical thing everywhere, but uniform guidance says it specifically. So it says, findings for which question costs are less than $25,000 known, but with likely question costs greater than 25 are still automatically findings. Okay? What happened on the next score? Oh, KPMKE got that correct. Casper's up now, and Blackjack made it to the screen. So here we go next. If you go to a wedding chapel built post-70s by law, they share what characteristic? Operated by a church. I'm not sure God wants anything to do with it.
Now, how do you know what God wants?
I don't know. Trust me, I have no clue. If I guess I found him in a wedding chapel in Vegas, he'd be happy anyway. Not freestanding. It can't be its own building. Okay. KPMKE, no changes. We're down to the last question. Let's go. Which statement on percentage, two questions. Which statement on percentage of coverage is correct? % of total awards for a low-risk auditee, that is uniform guidance. 25%, the other main pick there was still A133. Well, Halvor, you have a chance if you're on a roll, you could probably catch KPMKE if they miss it. So let's find out how it goes. What is the type A threshold effective under UG? Freebie. It's a freebie. Okay, we got a lot of good answers there, so how did it go? Okay, click the results. Wow, Barney came up. Okay, KPMKE. ¿Dónde está? Awesome. Most worlds, the black cards are cool to get, but it's one white. Okay, congratulations. Barney.
Back here. I'm not gonna say anything.
How's Andy doing today, Barney? How, Lord? That's some consistency there. Blackjack. Okay, I am Groot. Okay, oh, you're all together. Guys may be nervous. Okay, Sean. Congratulations. Thank you for playing. Sean and Chris are here from the Tidwell Group, and they've kindly consented to come out and talk about the new RD requirements. I offered them the morning slot, but they're not going to get up in the morning.
Politely declined.
They politely declined. So a lot of things are happening. They've consented to come out here and give this update. Kind of hope to clear up the final confusion, right?
Hopefully.
Hopefully. So we'll give them the time, welcome up, and we'll get started.
All right. Good afternoon, everyone. Again, my name's Chris Bailey. I'm with the Tidwell Group. During lunch, Les told us about maybe he thought 30 to 40% of the audience either had RD clients, worked with RD. So I think he basically gave like 60% of you a chance to leave for this session if you'd like. So we'll go ahead and give you the key word now, and then no hard feelings if anyone wants to get up and go. So the key word for this session is curry. Curry. We'll go ahead and give that again at the end in case anyone needs it. All right, so we'll just jump right in. Just a real quick overview of what we're going to talk about. We're going to talk about the history of the changes with RD, the reporting. We're going to go through the change in the reporting thresholds, the changes to the financial statements, the changes to the Chapter 4 of the handbook. We'll go over a few of the unnumbered letters if we have time, and then if there's any questions that you all have. We actually would prefer if you'd ask questions during the presentation if you have them. We don't want to just stand up here and lecture at you. If you have questions, please feel free to stop us.
All right, now I'm Sean Hutton, and I guess I wanted to give you guys a little bit of history of these changes and kind of how it's progressed. But I guess before I get started, is there anybody in the room who works at rural development? Okay, good. So we can badmouth them all we want.
Good.
So this has been a process that's really taken some time over the past several years. And kind of how it all started was back in 2013, the national office reached out to a few different accounting firms, our group included, to kind of come up with a new methodology for what the reporting requirements were, what the thresholds were that required an audit versus another service, as well as hopefully trying to align the reporting requirements and the testing procedures with HUD. So back then, what we did, we provided RD, with our suggestions, and they took that and said, thanks, that's great. And then they sat, marinated on it for a few years, and then 2 years later, they finally were able to get something posted in the Federal Register, a draft of what became the final rule. Took some comments back on that, incorporated those into what we provided to them, as well as any other additional thoughts that came up since that comment period ended. And then after they did that, 2 years later, 2017, they actually posted in the Federal Register that final ruling. So that was about almost a year ago at this point when they posted that final ruling, kind of detailing out what these changes were. And I guess kind of just to show you how the government seems to work, and I'm sure you guys all know, that nothing can ever be done right away. It's phased in over some sort of time period. So even though the final ruling came out in 2017, it is optional for 18, and we can talk about this a little bit further as well, but it's optional implementation for 2018, and then it is mandatory for 2019. And kind of the thought process behind that was when the final ruling came out, these properties had already submitted their budgets for 2018, and that's one of the things that RD really harps on. I'm sure you guys know is those budgets and do cost align with what was budgeted. So this gave them those properties that might now require an audit that didn't require an audit previously. It gives them an extra year to build that increase in audit fees, build that into their budget.
All right, so they wanted to make a change in the reporting threshold. So basically, before the new regulations came out, RD, the thought process was if a property had less than 24 units, it did not require an audit. If it had 24 units or more, it did require an audit. So with this new ruling that came out, they really kind of they said they had three objectives. The first objective was to align RD with HUD. They really wanted to try to make the requirements aligned with HUD. They wanted to focus on higher risk properties, and they wanted to, they thought that their thinking process is that they'll reduce the financial burden, the cost of financial reporting, basically lower audit fees is basically what they're saying for certain properties. So it was previously unit-based, and now, as I'm sure most of you are familiar with the HUD rules here, this is going to be very similar. It's based on federal financial assistance received during the year. So if it's for-profit, if it receives over $500,000 in federal financial assistance, it will require an audit. If it's not-for-profit, over $750,000. So what's included in the federal financial assistance? So it's going to be mortgage balances, your RD 515 balances, your RD 538 balances, your rental assistance, whether it's from RD or Section 8. Interest subsidy would be included. When you enter into an RD 515 loan, a lot of times you will sign an interest credit and rental assistance agreement, which basically will lower the effective interest rate on that loan to 1%, approximately 1% over the life of the loan. So the difference between that stated interest rate on that loan and that 1%, they want that interest subsidy included in your federal financial assistance. And then if the property receives any federal grants, again, these are pretty typical things, and that would be included. So what if there is no audit requirement? What if they fall below these thresholds? What is RD requiring? And there was a little bit of confusion, I think, when they were initially going through this, and some of the draft material that they put out. People were confused, but I believe what's going to be in the final ruling when it comes out, from what we've understood, is they're going to want a compilation of prescribed forms. So basically they're going to want a compilation report and their forms, 356010 and 3567, and they are not requiring footnotes. So that would be for the entities that fall below the threshold.
And just for a little bit further clarification on that, I think that initial draft that maybe some of you guys have seen as far as if an audit wasn't required, that I don't remember exactly what the wording says, but it confused a few folks, and they were concerned that they were going to have to do a GAAP financial statement, a GAAP compilation financial statement in addition to these forms. And RD is really only looking for their forms and the supporting schedules for those forms. Yes, with the compilation report, correct.
Okay, this is just a determination worksheet that RD kind of has put out, and something similar to this will be in the final audit guide. But basically, it's very simple. This is just a way for the property. We hope the properties themselves do it, but a lot of times that falls to the CPAs as well. So this is just a way to kind of go through and see whether an audit will be required. So you're going to list out all the different IDs that are, some properties might have more than one project associated with it. So obviously you would have to add all of those up to get your total federal financial assistance. So you're going to go through this, and again, you're going to use and again, this is very similar to the uniform guidance. You want to make sure that you're using RD 515 loan balance at the beginning of the year. So that's what's going to trigger an audit or not, that beginning of the year balance. Again, put your subsidy, your rental assistance, add it all up, and that's going to be your total federal financial assistance. And then I just pulled a few different excerpts of maybe where you can pull some of this information from. So this is from the 356010, the RD form. Line 26, so this is a comparative form, and the first column on the left, that's your current year. The column on your right is your prior year. So that prior year ending balance, current year beginning balance is the same. So again, that line 26, that's going to be your RD 515 loan. If the property has a 538 loan, it would not be included in line 26. So you might have to get that balance from the footnote or trial balance or something like that. When it comes to the rental assistance received, again, just another excerpt. This is from 3567. Line 2 is going to be your RD rental assistance. So again, if your property gets Section 8, it should not be reported in line 2. It would actually get reported up in line 1, and you'd have to pull that subsidy number from another spot. Interest subsidy, this is all over the board. Some people in their financial statements, so this would be an income statement, gross it up, so they show the interest subsidy income and expense grossed up, so you could pull that number there. Some people don't put it in the financial statement, so it might be in a footnote, but you could also find it on the year-end RD mortgage balance on the mortgage statement as well.
And I guess one thing I wanted to kind of hopefully hammer that point home is even regardless of if that interest subsidy is presented on the financial statements or the tax returns, that's still included in the determination of whether an audit is required. So regardless of if it shows up in the financial statements, it still needs to be included.
So once you get that total number, that total dollar amount, again, they want to work you through this determination worksheet. So step 2, is the RD project owned by a nonprofit? If your answer is yes, they're basically pointing you towards another section of the handbook that's going to follow your single audit requirements of whether an audit is required or not. Again, if it's a not-for-profit, it's going to follow a very similar determination, but related to the 750. No, we move on down to step 3. Step 3 is going to ask, did they receive $500,000 or greater? Yes, then an audit is necessary. No, and then it has you to go to step 5. And we'll talk about step 5 when we get there. And then hold on, go back one. And then on step 4, this is where, again, so now an audit is required, but are there any individual programs that are greater than $500,000? So is the mortgage balance itself greater than $500,000, as opposed to just everything in the aggregate being lower and added up to that threshold? So again, if it's yes, then we're going to have to, that program is a major program, and a major program report will be required in the audit, very similar to HUD. So again, if no, there are no major programs, audit is still required, but no major program report is required in the statements. And again, step 5, so if you're below the threshold, where they point you to step 5, and if for whatever reason, if the property has to do an audit for another agency or regulatory body, they want you to submit that audit to RD. So at that point, you wouldn't have to do a compilation. You would just submit the audit that you're already doing for that other agency. And again, if no other agency requires that, then you go to step 6, and that's where they're saying this is where you're going to do the compilation of prescribed forms.
What if the partnership agreement calls for it?
If the partnership agreement calls for it, then yes, you would do an audit, and then you would submit that audit to RD.
Could we just compile 3560, or do we got to do a complete supplementary information on the audit of 3560? Same difference, but what do I got to take reporting requirements-wise?
For the
If I have under 5 or my partnership agreement says I got to audit the financials, they got tax credit for that, but do I have to audit 3560, or can I just throw this compile supplementary information in there?
I think that RD is looking for the audited version of that. So, and they're not very clear on a lot of this stuff. They're just kind of trying to feel their way through it. But from the conversations that I've had with them, like I said, if the partnership agreement is requiring it, they're still looking for this new audit with the various compliance and auditing those 3560 forms. That's the sense that I get from them at this point. And, sorry to cut you off, Chris, but I guess right there kind of is a good point to talk about implementing early versus just doing it next year in 2019. Now, based on the conversations with RD, they don't anticipate many folks at all implementing for 2018's reporting requirements. Now, the ones that they do expect to see implement early would be the ones that would no longer need an audit. So those ones that would fall below that $500,000 threshold, they expect them to implement early, but any of them that will stay in audit or ones that will now become an audit, they don't really expect anybody to early implement. There's no real benefit to RD or to individuals to go through that additional compliance report and include that in the financial statement. So RD isn't really looking for that this year unless it goes from an audit to something lesser. Good. Go ahead.
Okay, so we were curious about this, and we just wanted to kind of see what it all looked like. Because again, we talked to RD and I think kind of asked them. So have you guys done an analysis on this to see if and the answer from them was kind of like, not really, but we think that there's going to be less audits for this. So we were just kind of curious. We did a little study of some of the RD properties that we have in our portfolio. We tried to get a pretty good sample from different states all across the country. So we took we sampled about 300 of our RD projects just to see, like, with this new requirement, how are things going to fall. So basically, on our 300, we had 19 that went from compilation to audit based on the new requirement. So these were ones that were under 24 units, but now have over that thresholds in federal financial assistance. And we had 6 that went from audit to compilation. So again, that's going to be like a net 13 additional audits just based on that small sample size. Now, obviously, if you can extrapolate that data, and obviously, we can say there's approximately 600 more audits across the entire portfolio. Now, again, it's a very small study, but we think that it, initially might be an unintended consequence of this rule, that they're actually going to have more audit fees. However, on a long-term perspective, all of these properties were stuck based on the number of units they had, whether they had an audit or not. So over time, as these properties start to pay these mortgages down and down and down, a lot of them will get to a place where they no longer require. I just don't know that it's going to be year 1, year 2, year 3, like maybe they were expecting. And again, I think there will be pockets of places across the country. We spoke in Indiana, and our friends from RD were in the room in Indiana, and one gentleman spoke up and said that the analysis he had done on his little area of Indiana, he thought he saw a decrease in audits in that area. But again, that was just his section of the state. So we'll see, I guess.
Yeah, and that was one thing that I was just shocked when our conversations, earlier this year with RD, during those conversations, we just asked them, have you guys done an analysis to see how this is going to affect your guys' portfolio? And I was just dumbfounded that they were like, no, we think it's going to be good, right? Well, what do you think? So I really think that they thought that those older, smaller properties, that they would have paid down their mortgage enough that they wouldn't require an audit. And that is the case for some of them, like Chris said. And there are some, too, that are still going to require an audit, this year or next year, but they're close. They're right there on the edge of whether or not they need it. So it is going to help some properties. And you would think that those older properties that are smaller probably don't cash flow as well, so this will be a benefit for them. I just don't think that the overall net effect is going to be quite what RD thought that they were going to get into. So moving along, one of the things that I know that us accountants, at least myself personally, was most excited about with this change was the removal of the AUP reporting. I mean, I don't think when the AUP testing came into effect, whenever that was, another one of those things that I don't think was necessarily thought completely out and how it would help or hurt RD. And I just don't think that the testing really provided much substance to RD. So getting rid of that, that's great. It makes us accountants happy. It's not really a change, but under the new reporting requirements, you're still going to have that standard government internal control, that yellow book report in the financial statement. So that's not going to change. Like Chris had mentioned, during going through that determination worksheet, they do have that now threshold to figure out whether or not the properties have a major program or not. So it's that $500,000. So if the property does have an audit, based on our little study that we did, it's most likely going to have a major program because that mortgage is what is going to push them over the $500,000. So that's going to most likely be a major program. And I think that when we did a percentage analysis, because you know us accountants love numbers, was about 90% of the properties that were going to require an audit were going to have a major program report. And so if it doesn't have a major program, then the report isn't required. The one thing that, once again, RD, some of the stuff that they came out with doesn't necessarily make sense from us accountants is regardless of whether or not there is a major program, the compliance testing, they're not anticipating it to be any different from whether there's a major program or not. It's going to be the same, is what they have said. So just another one of those things that I don't know if it really makes sense to even have the determination then. Going back to what I initially opened up with, things don't really progress with RD and the government in general very quickly. So based on those discussions that we had with them back in May, they said that they were going to have their revised Chapter 4 of their handbook. They were going to have all those changes finalized by September. Well, it's now December and still nothing. Based on my most recent conversations with RD, what they're hoping is within the next 2 to 4 weeks that they will have an unnumbered letter published to go over the reporting requirements for 2018. Now in that, they'll kind of go over some of the things that we've talked about, whether you're implementing early, what that process looks like as far as how do you notify the local servicing office if an audit is no longer required. So that will hopefully be in the next couple of weeks is what I've been told. When I asked them about the timeline for the audit guide and the revised handbook to come out, they said that's probably a little bit further out, probably January is what they said, but based on the track record of this whole process, I'm guessing it could be even further. Now, we're going to just hit on a few of the changes in the handbook. A lot of these are more, I guess, geared towards the property owners and property managers, but the ROI, that return of owner investment or the RTO, return to owner, they tried to clarify a little bit the wording of when you can take it, how it's paid out, et cetera. So the wording that they put in is that you will be able to pay the lesser of the maximum amount of RTO or what was budgeted. Now, most places just budget max amount anyways, but if for whatever reason the max was, say, $6,000 and they only budgeted $3,000, RD is saying you can only pay $3,000 that year. Another thing that they tried to clarify a little bit was the payment of previous years that had been unpaid or partial years were only paid. So I guess to be able to do that, though, you must have surplus cash. And we'll go through the calculation of what that surplus cash looks like here in a second. But basically the way that works out is, so say year one, you have a property that had budgeted for an RTO. They didn't pay it in year two like they were allowed to, and then say year three comes around and they have some of the surplus cash, then they can pay that year. Anything previous though, and say year zero, if they hadn't paid that, it's just gone and written off forever. They'll never be able to pay that money back. So essentially you can pay your current year and your prior year if you have that surplus cash, but anything previous, you're never getting. So here's just an example calculation of of how you determine if that property has surplus cash. So if you take that number from the 3560-7, that budget to actual form that they have, line 33, that ending cash, is where your starting point is. From there, you back away if there was any tax and insurance escrow that's included in that total. Then you also take out any accounts payable that they might have. That gets you your cash available, and then they want you to reduce that even further by what they determine your cash required is. So that cash required is the O&M total, so any operating maintenance, utilities, administrative type expenses, but not including your tax and insurance. You take out that amount, and RD wants you to have 20% of that total in your cash. So that's where you get to that surplus cash. So just to kind of go through another example.
Hold on, Sean.
Percent of the current operations and maintenance is coming from your audit?
Sorry, say that again?
Just 20% of operations and maintenance expenses coming from your audit?
Yes,
Okay,
Yes.
so not your proposed budget that you also submit?
correct, from the audit.
Okay.
Yes. So what he asked is the 20%, does that come from the audit or from the budget? And what RD is looking at in that regards is from what came from the audit, what your actuals were. So I guess to go through an example real quick. So we'll just use these numbers and say that you had $6,000 of surplus cash. And if you had, let's say that the maximum RTO that could be paid for this property was $3,000. If year one hadn't been paid, and the property had this $6,000, they could pay year two and year one for that RTO. So in that case, they get to pay their full RTO for the past 2 years. Now, to change the example a little bit, so say that their maximum was $4,000. The way that RD wants to work it in that situation is, so say you have that same $6,000 of surplus cash, your $4,000 for your current year comes out of that first, and then you can only pay $2,000 of that prior year. So that $2,000 for the prior year that you didn't pay, just gone forever. And really, RD, what they're trying to do in that sense is to keep as much money in the property as possible. So if you did prior year first, then current year, you could just kind of kick that can continually down the road until you had enough cash to pay both years. Whereas here, if it's not paid, since you're doing current year first, then prior year, then that $2,000 that didn't get paid just falls off and more money staying in the property. So this isn't really a change per se in the handbook. It's just something that I guess not a lot of people are aware of. So I just like to bring it up. And what it is replacement reserve interest. So the owners, they obviously want to try to get as much money out of the properties as they can. And this is just another avenue for them to get a little bit extra money. Now, what they're allowed to do is they're allowed to withdraw 25% of the interest earned on the replacement reserve account and basically pay it out as an additional return to owner. Now, how that works is you basically have to submit a replacement reserve withdrawal request to RD with the calculation showing what your prior year interest was and what your 25% cut is. Now, that's on top of what your max RTO is. So back to our previous example, if you had $4,000 as your max, you could pay that full $4,000 plus this 25%. Now, a lot of owners, I know it's not worth it to them just because interest rates are so low, it's not really worth it. But for some properties that have substantial replacement reserve accounts, they could be making a few $1,000s in interest a year. So that's just an extra, few $100 in the owner's pocket. So that makes them happy. So we'll talk just very briefly on the audit guide. We're not going to necessarily go into great depth on the individual steps. Did you have a question?
That distribution of the replacement reserve interest, that's not subject to the 8% RTO or
Correct.
that's
Completely separate.
Hey, we got a question.
where do you report the withdrawal from the reserve for replacement?
That will go typically on that, I don't remember the number of that line, but it's the essentially operating deficit is where that typically is shown. And I know that doesn't necessarily make sense, but that's what RD has told us where to report it, because we do have a few clients that take advantage of that. On that part 3 of your 3560-7, the reserve analysis, they've said that to put that on that operating deficit line. Just in the comment section over there, just kind of detail out that that's your 25% interest earned that you can withdraw from that account.
On the placement return to owner, what if the placement reserve is underfunded? Does that create a problem?
Yeah, so the question is, if the replacement reserve is underfunded, does that create a problem as far as paying the RTO? Yes, and that's one of those things that I know that typically that first factor of whether or not you can pay that return to owner is if that line 30, the net deficit gain in cash on the 3560-7, if that's a positive number, that's your first indicator of whether or not you can pay that return to owner. Then RD does look at things such as if your replacement reserve is underfunded, and if that's the case, then you won't be allowed to take that return to owner in that situation. Correct. So back to the audit guide. Now, like I said, we're not going to dive into it in too much depth. I just kind of wanted to give you the compliance sections that RD has currently outlined as areas for compliance procedures. Now, the guide itself, basically how it came to be where it is currently is during this process of working with RD through the multiple different firms who are involved, we kind of created a draft audit guide. And RD just kept saying, we want to be more like HUD, we want to be more like HUD. So essentially what we did, for all intents and purposes, was take the HUD audit guide, the procedures, compliance procedures, copied and pasted it, and then tweaked some of the wording so that it was more rural development specific. So there's language in there as far as certain forms to look at, like the FIN 2100, which is a replacement reserve form, some of the other things like that. But overall, the procedures are very, very similar to what is in the HUD audit guide. So the various areas are, and sorry, for quick clarification, I don't think that this was initially included in the slides that you have in your book. This was something that I think I added after I'd already provided those slides to Les and his group. So it includes, like I said, very similar things to what's in the HUD audit guide: mortgage status, replacement reserve, that return of investment, return to owner, equity skimming, which there's not really much procedures specifically in that equity skimming section. It kind of rolls up into some of the other areas. Cash receipts, cash disbursements, tenant security deposits, management functions, unauthorized change in ownership, and unauthorized loan of project funds. Now, to take a quick step back, so cash receipts, even though that is a section in the compliance guide, that is one spot that is maybe a little bit different. You're not required to select a sample of disbursements, receipts, as of the way the guide stands most recently.
But back to that, on the cash receipts, you're not going to take a sample. How are you going to test it?
So the question is, if you're not taking a sample, how are you testing that, correct?
Correct.
So the way that the guide kind of lays it out is you're not looking at specific receipts, you're looking at other various documents that are kind of already reviewed and approved by rural development, and that's kind of one of the key components here is RD, like I mentioned earlier, is very concerned about the budget. They look at it, approve it, and then the actuals that get submitted to them, they compare that to what was in the budget. So they're looking at a lot of stuff already. So that's kind of why they've pared it down a little bit in some of the procedures, because they feel that they already have good oversight in those areas. So like I said, they're just having you look at some other forms that are essentially already RD approved.
I think it's time to
Oh, yeah.
take some more of Les's money, right?
Any questions?
Yeah, there's one.
Go on over here.
Wait a second.
Oh,
When they removed the AUP reporting requirement, did they put any additional like guidance in it about saying what we should be doing in lieu of that, or is that just, hey, we're gonna punt it until we get to this?
So they didn't put anything in writing. They basically just said it's gone for now. That AUP report is no longer part of the financial statements. What they kind of told me over the phone, so there's no actual documentation of them ever saying this, but what they've said is that they still want people, since that yellow book report is still part of the financial statements, they still want people to review maybe a handful of disbursements. And when I asked, well, what does a handful of disbursements mean? They said, well, just use your auditor judgment. So they didn't really, it's another one of those things that I don't think they completely followed through, but they did say that they did want us as accountants to still review some of those compliance areas as part of that just yellow book reporting that we do.
So essentially do the same procedures, just don't put it in the report.
Essentially. And they gave us that little bit of a auditor judgment about how much we test. So maybe instead of testing 15 or 20, 25 disbursements, maybe you're only testing 10. It's whatever you feel comfortable with. And I guess another thing to hit on a little bit as far as the audit guide and kind of in relation to that, auditor judgment is that RD wants nothing to do with group-based testing. That was another thing that I asked them as far as, we're getting rid of AUP. What do we need to test? Can we get away with, if we have an owner that has 20 properties, can we group-based test those disbursements? They said, nope, absolutely not. We want you to test every single property the way that the compliance procedures will state. So unfortunately, no group-based testing. All right, if there's no other questions currently, we'll hop in and we'll do another round of Cahoots. So what do I do from here? Hey, Les, how do I get to the next?
yeah. Classic. Start. This one only has 10 questions, so you got to be on your game.
Otherwise occupied in a conversation back there, but I guess you showed the unnumbered letters, but obviously one of those is the new acceptable expenses letter, right? So whatever was in Chapter 4, when they issue that, will it have the new unnumbered letter requirements in it for those expenses?
That is the plan. That's what I've been told.
But right now, the other unnumbered letter is applicable today, right? Whether or not you adopt audit guidance, that new unnumbered letter with the changes in it for expenses is the one to follow for now.
Correct.
Right?
Correct.
Go Baker Mayfield, huh?
All right.
Drink time? Not yet. No, hold on. Keep that coupon in your in your badge for a minute.
All right, let's get started.
You ready?
Shorter game, here we go.
The biggest change to the RD audit requirements will be,
There's a little bit of judgment here.
there is.
We all agree, but I think the three of us looked at this again and said we still are happy with our answer, right?
Yes.
Yes.
They're not happy with our judgment.
And you know what? I'm okay with that at this point. But do you want to say why we think that's the better answer?
So I know that I said earlier that, for us accountants, the biggest thing was the removal of that AUP because it wasn't really beneficial. But that was, I guess maybe we could have phrased the question a little bit differently. What's the biggest addition to the report? But really, fundamentally, the biggest change we felt was that opinion on compliance, because that was something that wasn't really in there before, even when that AUP reporting was in there.
Even RD OIG, right? When they went back, we were talking about the old days where we got the actually AUP in. They're complaining you don't have enough findings, you don't have enough testing, you don't have this. And I said the problem with that challenge is it's not about the testing, it's about what you asked us to do. If you required an opinion on compliance, the way HUD did, the focus of this audit changes dramatically for the auditors. And you are forced to report based on the major program requirements, not on the yellow book or financial statement requirements. There's just a lot fewer findings in general. I think they're hoping that, I know this isn't a thing we would say out loud or they would say out loud, but I think if you're talking to OIG, they're counting on there actually being theoretically more chances to catch noncompliance by having auditors focus on opinions.
HUD's up at the top.
RD's
Under the new guidance, RD properties that do not require audits still must include footnotes. True or false?
Ooh, we're flying in.
Man, pounding those. That's a lot of pushes, huh?
Answer is false. Now, we talked about this a little bit. There was some initial confusion when RD first published this, or the draft came out and some people got their hands on it. There was some language in there that kind of talked about a full compilation with, gap compilation. After various conversations with RD, like I mentioned earlier, they don't really want that. They just want their forms, no footnotes necessary.
Way to go, Aggie Laird.
Which of the following will not be included as supplemental data? R for R schedule. Now this is could be construed as another little bit of a trick question, because within that 3560-7, it does have a section that details out the replacement reserve activities, but it's not its own separate schedule within that supplemental data.
And the other thing here is, remember, the big difference between HUD and RD is RD's tracking something in EMPHAS they call required reserve balance. So they think they've already got the right reserve, don't they, Benny? Aggie Laird, way up there. It's close.
What percentage of O&M expense is used to calculate RTO/surplus cash? 20%. Good response there. Downtown jumping to the top.
Hold my beer. There we go.
Now we're playing for second, third, fourth, fifth, huh? Hold my beer.
There's still time. There's still time.
Hold my beer. Getting ahead of ourselves here.
And what year and where was the first CPA exam given?
Blame Les.
I know that picture may tell you. There were really only two choices. I mean, given the years, right? Some were way early.
Downtown still at the top, but it's getting close.
Boy, now it's a race.
Yeah.
Now we have a game.
Which ratio is not included in the RD analysis? Current ratio. Now, these are things that RD themselves.
Yeah, they're listed in the handbook. If you think about it, look, they're telling you right away how they're going to review your financial statements, kind of like what HUD does. And the current ratio is not on that list, but they're going to look at the other three ratios on that screen. So,
Downtown, hanging on. 538 guaranteed loans are included as federal awards to determine whether an audit is required.
That picture.
flip a coin.
The answer
Should
is
have copied your neighbor.
true. And I can't remember if we stated this earlier, but RD, what they're looking at for that
pause
538 loan, they're looking for that total outstanding balance, not
I
their
know.
guaranteed portion of that loan. They're looking for the total balance. When are we likely to increase fees in some RD audits?
Much to the chagrin of RD, right? I mean, they thought it was all going to go down.
Exactly.
Your numbers prove that was not. Now, Sean, on this one, compliance opinions are now required, but from RD's perspective on fees, what are they trading for that? They're trading AUP stuff for the cash disbursements test and the guide, and they think about even, but clearly projects less than 24 units that are now over 500 will see increases, and that's why this conversation is important now in planning for budgets, right?
Absolutely.
Yes.
Absolutely.
Oh, we've released a Kraken. Where'd the Kraken come from? The Kraken has a couple in a row, so that the multiplication stuff, bonuses are accruing fast.
What HUD audit guide step is not included in the proposed RD guide? Cash receipts sample. So like we had mentioned, the cash receipts is still a compliance section that RD wants us to look at, but a sample is no longer required. The Kraken's still up top.
Hold my beer is making a comeback. Think about
Last
that.
chance. How many man hours does it take on average for PwC to hand count the Academy Awards ballots.
Did it register it? It didn't go. I'm dead. It didn't know I was alive. Sorry, I touched your phone. It's okay. See, it didn't really bother me.
1,700 hours.
I'm so gross. There's a
At least
block.
that's what's on their invoice.
And they don't even announce it right? 1,700 hours later. The Kraken. You don't look like a Kraken. Release the Krakens. It's just a small payout.
Thank you.
23 units for what it's worth. FTW, 20.
For the win.
Where? I don't see their hand up. Way over there. Maybe I can ask one of you guys to hand out
Yeah.
TLO and these others. Okay, so the next one is 25. TLO is 25.
TLO.
23, where are you?
23 there.
What about not a winner?
25.
Okay. Not a winner,
20.
but a second winner.
I got you.
That's 20.
Let's use 20. Yeah, got it.
Now there's a tenner, right?
And then go Zags.
Go Zags! Okay, back over
Got
here.
it.
I'll get it. You guys can go get going.
All right.
Thank you. Congratulations.
We good, Sean?
Yeah.
All right. After all that fun and excitement, we'll get back to it. Just a little bit, we wanted to talk about what we deem to be the significant unnumbered letters for the year. So RD issues their guidance in unnumbered letters. Like Sean spoke about earlier, they're going to be releasing one more here before the end of the year to talk about the 2018 financial reporting requirements. So these are the ones that we thought were the most important to talk about. There's a couple here that we don't have slides for. The first one, multifamily housing financial reporting 2017. That's what we just went over. That's all the new requirements that came out late in 2017 related to the audit thresholds. Another one that we just wanted to briefly touch on was the 2017 multifamily housing occupancy report. So this unnumbered letter is about, 50 pages long, maybe 45. And it is just a bunch of data, demographic data, and all kinds of things that HUD's put together from 2016 to 2017 by state across the portfolio. And really what we wanted to touch on there was, I believe about 280 properties are going to be lost to the RD program, which equates to about 5,000 units based on maturing mortgages and or prepayment of that mortgage balance. So that was just something we thought we'd highlight.
Yeah, and to add to that, Chris, one of the reasons why we kind of thought that was important is for those of you guys who deal heavily in the RD world, they, a couple years ago, they came out and said that the world's ending, all these mortgages are going to mature in the next year or two. So even though they've kind of calmed and they realized maybe their numbers weren't the best that they initially published or put out there, but even though that crisis is still a few years away, just in 1 year the portfolio in general lost about 5,000 units. So that's still a lot of loss of potential places for affordable housing for the people who need it the most.
I don't want to get too off track here, but are you guys going into any RD mortgages that are showing negative interest? What's stupid with it? Or should I talk to the person?
It's a good question. So the question was, are we seeing any RD properties that have mortgages that are showing negative interest? And nobody's exactly sure how it happened. One of the theories is that, as these properties were built, any excess funds that they had that they didn't need to use for construction were then used to pay down the initial mortgage up front. So they didn't necessarily think about how that was going to affect that interest subsidy that they were receiving on the back end. So because of that, the loan wasn't completely re-amortized at that point. So the payment stream kind of has thrown things out of whack. How to fix that? I don't think there is a great answer to that right now, besides potentially re-syndicating, transferring that to a new legal entity, at which point it will be re-amortized, or going through the NPR program, something like that could, debt defer that out. But that is an issue that we are seeing some individuals run into where they do have that negative interest. Yeah.
Yeah, you get reported as income.
Yep. Unfortunately. Yeah, exactly.
So RD issued an unnumbered letter late March of this year, and what they were really doing with this unnumbered letter was clarifying the allowable expenses related to the nonprofit asset management fee. And we thought we would highlight this one. The nonprofit asset management fee is not new. It's not something they put out new, but it's something that we see used very often by clients. So we just want to make sure we're aware of it. I think that a lot of people aren't aware of it. So basically, if you're a nonprofit, you can get paid an asset management fee annually up to $7,500 to cover the reimbursement of actual organizational costs. And what RD was doing was they were clarifying what you could include as allowable expenses. So what you can include: admissions insurance, Board of Directors review and approval of budgets, financial statements, capital expenditures, and long-term asset management review. With that, they did want to clarify in the unnumbered letter that if a nonprofit RD has an E&O policy that covers 3 properties, a $3,000 policy, each property can only take $1,000 towards that $7,500 asset management fee. Not $3,000 per. They wanted to make sure that was clear. But basically, you would budget this amount. You would come up with a dollar amount that you could have an asset management fee for these expenses. Up to $7,500, you would budget that. You would submit documentation to RD for their approval. And add positive cash on line 30 of the 3560-7, as long as you had positive cash there, which is that same trigger that allows you to take an RTO. As long as you had positive cash there and HUD had approved your nonprofit asset management fee, you could also take that on a yearly basis. And then they also issued another letter in April related specifically to some hurricane damage, and specifically 3 hurricanes, Harvey, Irma, and Maria. HUD basically, they designated $71 million of RD 515 funds. And the purpose of this was for actually declared disaster areas related to these hurricanes. Flood insurance was not required. So basically, these hurricanes caused damage that out of the normal scope of their flood insurance. They put funds up there for that. Again, the loans would be very similar to a 515 loan, a 30-year term. It's over 50 years, or the remaining economic life of the property, whichever is shorter. All the funds are supposed to be obligated by September 30th of 2019. Go ahead, Sean. And application deadline is May 31st of 2019. And then they just listed some things to include in your application. Application for federal assistance, the estimate certificate of actual costs, and a list of repairs. They also said in the unnumbered letter that even if you had flood insurance, but you weren't required to have it. If your repairs were over and above what your insurance covered, you could also apply for these funds. And again, obviously, if you are awarded, or as you go through that process, HUD will probably ask for additional documentation with that.
So one of the other unnumbered letters that the RD put out this year was in relation to protective advances. And I guess the reason we included this as one of the significant items is when Chris and I actually gave this presentation a couple months ago in Indiana, the question came up about, for that determination of whether an audit is required, should these protective advances be included in that determination? And the answer is yes. There's not any specific wording in that audit determination letter that the RD has, but it is funds that they are presenting to these properties that potentially, are struggling. Just, those typical struggling properties that don't cash flow, and because of that lack of cash flow, either there's concerns for the tenants, are they in a place that's, safe and decent housing, as well as RD wants to protect their own interest in that property. So if the property isn't able to pay their real estate taxes, and that might potentially create a foreclosure / additional lien on the property, RD is wanting to protect their own interest. So they're giving these properties these advances to kind of help cover those shortfalls. Now, like I mentioned, real estate taxes is one item that these advances could cover, as well as things like the immediate essential things to make sure that those tenants are in a decent place. Utility bills, once again, if the utility bills aren't paid and it could potentially cause an additional lien on the property, RD doesn't want that, so they might give these properties advances to help cover those costs. And then once again, the health and safety violations as well. And there is a process that actually is kind of started through the state RD office. It's not necessarily, there are discussions between the property and their local office, the state office, but the actual application process starts with the state level and is then forwarded along to the national portfolio management portion of RD. Another item.
Are these going to have to
Sure.
be repaid? Are they just going to be advances? Or are they going to be?
So the question is, are these advances going to have to be repaid? And the answer is yes, RD is hoping to be repaid, but they also understand that these are struggling properties, so that might be a little bit difficult. The way that the unnumbered letter kind of presents it out there is that these will be amortized somewhere between 1 year, 5 years for that repayment term, but RD, once again, understands that these properties are struggling, so they might not be able to get that turned around to repay those funds. So then the unnumbered letter that they put out in middle of September related to reallocation of that rental assistance. So those RA units that were recaptured either through a property leaving because they've prepaid their mortgage or their mortgage is just naturally matured, those RA units that those properties have get kind of recollected by RD, and RD finally, earlier this year, said, here's how we're going to get them back out into circulation to help these properties. So this is something, once again, going to that maturing mortgage issue that kind of is lingering for RD. This is something that I think is going to be happening a lot over the foreseeable future. But basically what they're doing is they're looking for properties that struggle with vacancy issues. Now, going back to that occupancy report that Chris mentioned a little bit ago, the portfolio-wide, there's only about a 7.5% vacancy rate across the whole portfolio. But for these instances where there is those large vacancy amounts, they're trying to help give those properties additional RA units that could then in turn hopefully fill those units with tenants. And it's also RD is also looking at individual tenants who they themselves are overburdened by their rent payment.
Where does this start? State level?
The state level, correct, yes. And I don't remember the exact timeline, but the state offices have, from when those units are recaptured by RD, the state offices have a certain time limit in which they are required to get those RA units redistributed. And if they don't do it in that time frame, then the federal RD office is going to kind of take over and they're going to oversee the process. But it does start at the state level.
The state doesn't have any of these units coming where the rental assistance coming back, so there'll be nothing to apply for.
Correct.
I think it's they list in the unnumbered letter every state and the total number of units that they have available that's coming back to them, as well as I think it's 100. I can't remember if it's 180 or 120. 180 days, I think they have to do it. And if the state doesn't do it, then then it goes back to the feds to.
But yeah, there are some states like Virginia and other states that have done a pretty good job of keeping those RA units in circulation that they don't have any to reallocate. But then there's other states that have had mortgages mature or whatever the case might be that they have a substantial amount. I've seen some of the states were even over 300 RA units that they could then reallocate across their state portfolio. So then jumping along, I know that some of my clients, this was one of their favorite unnumbered letters that came out throughout the year, and it's some of the loosening of the requirements for their replacement reserve accounts. Now, typically the way those accounts worked is that there was a requirement for the checks to be countersigned by an RD official, somebody from that local office that was approving those invoices, those withdrawals. That's gone. No longer required to have that counter signature. There's also they've kind of loosened the pledge requirements if the funds are in excess of those FDIC insured limits. So they've kind of loosened that a little bit where they're saying if you have that collateral agreement in place, that's fine, but if you have a new account, it's not necessarily a requirement. They just kind of suggest that if you do have an account where the balance is high enough, maybe you just spread those funds out between a couple different institutions. One of the action items for these owners and management companies related to this, though, is they do have to execute a new depository agreement with that financial institution that they have those replacement reserve funds with. Now, this is something that I do know has been a little bit of an issue for some owners. When they've spoke with their financial institution, the new depository agreement already provided an example of that to use. Some of those banks and financial institutions don't like the wording. They feel like it removes some of their protection of the accounts. So they're kind of balking at the idea of signing this new agreement. That's that's unresolved at this point. I know that some banks and institutions have no issues with this new deposit agreement, but others do. So that's kind of just an open item right now that RD with these owners and these banks are trying to kind of sort out where that's going to end. And I guess one of the big benefits of this was at least the removal of that RD counter signature is that once approved, after you have this new deposit agreement in place, once those reserve withdrawal requests are approved, those funds can be transferred immediately, electronically even. So if that's something that will help speed up your process with those replacement reserve withdrawals, that's a benefit that you can have there. I guess on the other side of this is something that was actually one of the initial things that held up the release of this audit guide, is the change of this procedure. Because with RD no longer requiring that counter signature, they're trying to incorporate into their compliance testing procedures for us accountants how we are going to test various things so RD knows that owners aren't taking advantage of that change in the requirements. Okay. So rent incentives. This was one that just came out in near the end of October. And this is something that actually has been a pilot program for RD for a couple years now. And there was only just a few states that were included in this. And I don't remember all of them. I know Florida, Ohio were part of this process. And basically, what this pilot program for these rent incentives, what it entailed was the properties, if they struggled with vacancy, so like I said, you know, the average across the whole portfolio was only 7.5% vacancies, but if the property was greater than that, and the actual percentages are 10% for units, or for properties that have more than 16 units, or 15% for smaller properties. So if they're above those thresholds, they can utilize this rent incentives. And so basically what they're doing, there's two different versions. For properties that maybe aren't filling their units that quickly, but still cash flow okay, they have one option that's a little bit less restrictive on the owners. They can actually still take a return to owner, but it's kind of potentially reduced. So let's go ahead to the next page real quick. So how this is determined is you can offer incentives to the tenants to help either move people in or keep people around. And basically what it is, you know, maybe you give them the first month rent free, or maybe you reduce for a year their rent by $100 a month. Whatever the case might be, those are a couple different options. And how the properties determine what their maximum amount of incentives is, they take that approved vacancy allowance from their budget and add into that their return to owner. So in this case, their budgeted amount was $2,500, and the max for the return to owner was $6,000. So you add those together, and you end up with an $8,500 maximum allowance. So they can offer those incentives up to that amount. So they can offer $100 off per month up till they hit that $8,500. Now, for, like I said, the properties that still cash flow a little bit, they're able to still take a return to owner as long as there's some of that budget, that maximum flex rent incentive, some of that left. So if they use, in this case, say $7,000 of their rent incentives, they can still pay that $1,500 additional as a return to owner. Now, for the properties that are maybe they have a workout plan that struggle more seriously, there's a lot more requirements, and one of them is basically you're not getting an RTO, but that's just one of them. So I think we are running out of time, so I wanted to leave it open for any questions. If you have questions and you just want to come to either Chris or I afterwards, feel free.
One comment.
Yes.
As a recap.
Just for 2018 recap, we're going to get rid of AUP. You're going to have a yellow book audit, the same as last year. Nothing else is going to change for 98% of us until next year, right?
Correct.
Yes.
So there was somebody that said, I'm a little confused that it's not clear about this year. So this year, same as last year.
Yes.
Do you have to notify the office that you're going to not do the AUP?
No, you will not.
It's done, right?
It's done. Yes.
So, yellow book audit only, till next year. The goal for most of this conversation is a budgetary planning. You need to let your client know when they will have those few who go up or down over the limit, right?
Yes. Yes. Any other questions? All right. Well, thank you, everybody.
Thank
very
you.
much. 10 minutes.